Good afternoon, everyone. Thank you for joining us today. You are very welcome to our Dillon Eustace webinar on next steps for ESG funds and their management companies. My name is Alana Hannon and I'm a Senior Associate in the Asset Management and Investment Funds Department in Dillon Eustace. I will be moderating this afternoon's webinar. Our speakers today are Dillon Eustace partners Cillian Breeden and Aisling O'Malley. Many of you will already know Cillian, who is a partner in our Asset Management and Investment Funds team. Cillian is a specialist in investment funds and he advises on a broad range of legal and regulatory matters. His clients include privately owned and institutional investment managers representing a wide range of asset classes. Cillian has also spent time on secondment in London within the legal department of a large US bank and in our Cayman offices. Aisling is also a partner in our Asset Management and Investment Funds team. Her extensive experience includes a wide range of legal and regulatory matters covering the structuring, establishment and regulation of all types of mutual funds, UCITS and AIFs, as well as advising on establishing and operating UCITS management companies and AIFMs. You may recall that in October and November of last year, Cillian and Aisling presented on the topic of the new Sustainable Finance Framework and its implications for funds and for their management companies. In this webinar, they'll be considering next steps for ESG funds and their management companies to ensure that they're in a position to comply with the additional obligations imposed under both the SFDR and the Taxonomy Regulation, which will apply from 1st of January 2022. In terms of running order and ground rules, Cillian and Aisling will present for approximately 40 minutes, leaving us with time for a 5-minute Q&A at the end. Everybody is automatically muted, but we would really encourage you to submit any questions you might have through the Q&A function at the bottom of your screen, which we will then call out at the end of the presentation. We would also just like to note that this session is being recorded. So without further delay, I will pass you over to Cillian and Aisling.
Thank you very much for that kind introduction, Alana, and hello to everyone who has joined today's webinar. We really do appreciate you taking the time out of your busy schedules to attend the third in our series of webinars on the topic of ESG. So as you'll see from this next slide, today myself and Aisling will be providing you with an overview of some of the new obligations under the SFDR, which is also referred to as the Disclosures Regulation, and the Taxonomy Regulation, which will each apply from 1 January 2022. I should say at the outset that this is a very challenging and complex legislative framework, and our key aim today is to provide you with a clear overview of the new obligations. On this slide, you will see a simplified chart of the legislative framework which will govern the new disclosure obligations imposed on ESG funds and their management companies under these regulations. Now, as you will no doubt be aware, the majority of Level 1 measures set down in the SFDR have applied since the 10th of March 2021. Now, this deadline saw the majority of Irish UCITS and AIFs updating their prospectuses and their management companies being required to update their policies and website disclosures to provide certain information to investors on sustainability-related matters. In a direction from the European Commission, impacted financial market participants were expected to comply with these Level 1 disclosures in a high-level and principles-based manner. The next milestone in the ESG journey for certain management companies and their funds under management is on the 1st of January 2022, when the Level 2 measures under the SFDR begin to apply. Before we take a look at these measures in a little more detail, it is worth noting at this juncture that, as shown in the slide, additional disclosure obligations may apply to funds which fall within the scope of the Taxonomy Regulation from that same date. We'll consider this later on in the presentation. It's important to remember that while the Level 2 measures under SFDR will apply to all ESG funds, it will also be relevant for any management company which is complying with the obligations relating to Principal Adverse Impact Reporting, or PEI reporting. For completeness, I should also mention at this point that these Level 2 measures have not yet been adopted by the European Commission and as a result are subject to further change. But it's worth taking a moment at this juncture to refresh ourselves as to what constitutes an ESG fund. And as you can see from this next slide, Article 8 or light green funds are those which promote environmental or social characteristics, although not exclusively, and which invest in companies that follow good governance practices. Article 9 or dark green funds, on the other hand, are those which have an objective of sustainable investment or reducing carbon emissions. Now, as you'll likely be aware, the lack of legislative clarity around what is meant by the reference to the promotion of environmental or social characteristics under the Article 8 definition caused significant headaches in the lead up to the 10th of March deadline earlier this year. This was when asset managers were trying to classify their funds under management as either Article 6 funds or non-ESG funds, Article 8 funds, light green, or Article 9 funds, dark green funds. Now, while the European Supervisory Authorities, or ESAs, themselves wrote to the European Commission in January seeking clarification on the scope of Article 8 and Article 9 of the SFDR, a response has not yet been published by the European Commission. Further adding to the complexity to this classification process are the proposed changes to the MiFID Suitability Assessment rules, which were published in late April this year, and which we'll take a look at in more detail later on in the presentation. Moving on then to the next slide, and in the Irish context, and again by way of market colour, it's interesting to note that further to a survey carried out by Irish funds across its Irish law firm members, we now know that as of 10th of March 2021, 15% of Irish domicile funds have been classified as Article 8 funds, with only 2% having been classified as Article 9 funds. The purpose of this next slide is effectively to level set and to illustrate the state of play under the SFDR as of today. Now, I won't go into this slide in too much detail right now, but as you can see, from the 1st of January next year, ESG funds and PEI managers will be subject to significantly more detailed and prescriptive disclosure requirements under the framework. This will impact on prospectus, website, periodic or annual reports, and the PEI statement. In this regard, it's worth pointing out that in an attempt to ensure comparability of financial products marketed as sustainable, the prospectus, periodic reports, and PEI statement must follow detailed template disclosures set down in Level 2 measures. There are, however, no templates to be followed for the website disclosures applicable to management companies managing ESG funds, but the information published on the website must be kept up to date. In noting that these enhanced disclosure obligations will apply from 1 January 2022, it's worth asking the question as to which rules apply to any ESG funds established between now and then. Do they simply need to comply with the Level 1 high levels and principles-based disclosures, or are they expected to follow the detailed template Level 2 disclosures? As you can see from the slide, a statement published by the ESAs in February this year sought to address this issue, although unfortunately the statement itself was not entirely clear. So on the one hand, it suggested that the draft Level 2 measures should be used as a reference to comply with Level 1 disclosure requirements, while on the other hand, it recommended that this interim period is used by financial market participants, so management companies for example, to prepare for the application of Level 2. Now, our experience to date has been that the Central Bank has not asked ESG funds which have been established since the 10th of March to comply with the more onerous disclosure obligations imposed under Level 2, and naturally that would make sense given that they're not yet in force. On that note, I'm going to hand you over to Aisling, who will take a closer look at some of the SFDR Level 2 disclosure obligations.
Good afternoon to you all. As Cillian mentioned, the Level 2 disclosure obligations will impact the prospectus, periodic reports, website disclosures and the PEI statement. We're going to consider each of these in turn, starting with the prospectus disclosures. Under Level 2, the prospectus disclosures must follow a prescribed template and address specific matters. The draft Level 2 measures suggest that the finalised template disclosure be annexed to the fund documentation, i.e. the prospectus or the fund supplement, with the prospectus or supplement then containing a cross-reference to this ESG annex. The type of information that must be provided to investors under the Level 2 measures is significantly more detailed than that required under the Level 1 measures. By way of example, under Level 1, it was necessary only to describe how environmental or social characteristics promoted by the fund were met, whereas from the 1st of January onwards, the prospectus, via the ESG annex, must describe the specific environmental or social characteristics being promoted, as well as listing the sustainability indicators which are used to measure whether such characteristics are met. Just to mention, these same indicators must also be included in the periodic reports to report on the extent to which the environmental or social characteristics have been met. Of course, under the existing Level 1 measures, management companies should already be disclosing such indicators on their website. Other disclosures required under Level 2 measures include explaining the binding elements of the investment strategy and how good governance of underlying issuers is assessed. Under Level 2, the ESG annex in respect of Article 8 funds must also include a graph which discloses the minimum proportion of assets which are used to attain environmental or social characteristics, including any allocation to sustainable investments. This graph must also disclose the purpose of the remaining investments in the portfolio, and similar obligations are imposed on Article 9 funds. Turning to the next slide, you'll see an extract from the Level 2 measures which contains the graph which must be used to disclose the asset allocation of an Article 8 fund by way of example. When managers are considering what to disclose as regards minimum proportions, the following points are worth bearing in mind. Firstly, the actual proportion of such investments must be disclosed in the periodic reports, and as a result, managers may wish to apply conservative figures in the prospectus disclosure in order to avoid a scenario where the fund is reporting negatively in its periodic reports against what it has committed to in the prospectus. And secondly, the proportion figures included in the prospectus are intended to be target figures only and should not be considered an investment restriction. Turning now to the next slide. We look at the disclosure obligations applying to the periodic reports of ESG funds. In the case of Article 8 funds, Article 11 of the SFDR sets down an obligation for the periodic reports to provide information on the extent to which the environmental or social characteristics have been met during the reporting period. And in the case of Article 9 funds, to provide information on the overall sustainability-related impact of the fund during the reporting period. These high-level disclosure obligations are then expanded on in the Level 2 measures, which set down more detailed and prescriptive disclosure requirements. And the purpose of these disclosures is to report on the progress of a fund in achieving the commitments given by the manager in the prospectus. Moving to the next slide. I mentioned earlier that the prospectus template incorporates a graph on asset allocation, setting out the minimum proportion of assets that promote environmental and social characteristics. A similar graph must be included in the periodic reports, but the minimum proportion figures must be based on investments held during the reference period. The periodic reports should also disclose how the indicators disclosed in the prospectus to measure sustainability progress have performed during the reference period. In addition, the periodic reports should also provide investors with specific information on the action taken to attain relevant environmental or social characteristics or objectives during the reference period. The timing of the application of these disclosure obligations has been the subject of much industry discussion and speculation. Both Level 1 measures and Level 2 measures apply from the 1st of January 2022. However, it is not entirely clear how this should be considered in the context of financial periods covered by the relevant periodic reports, i.e., whether it applies for financial periods beginning on or after the 1st of January 2022, or whether it applies to financial reports published after that date. In a supervisory statement published by the ESAs in February, they indicated that any financial statement published in 2022 would need to comply with Level 1 SFDR measures, which would mean that annual reports covering a period ending on the 31st of December 2021, by way of example, and then published in April of 2022, would need to comply at a minimum with the Level 1 disclosures. Furthermore, and depending on the timing of the finalising of the Level 2 measures, it may be the case that the Level 2 measures also need to be addressed. The ESAs have, however, called on the European Commission to clarify that the detailed Level 2 disclosure obligations only apply to periodic reports relating to financial periods beginning on or after the 1st of January 2022, and have recommended that the periodic reports of ESG funds published in 2022 in relation to financial periods which start before the 1st of January 2022 should only have to apply the high-level and principle-based requirements per the Level 1 measures, and should not be required to comply with the more detailed Level 2 measures if it is the case that the finalised Level 2 measures are not adopted by the European Commission before the end of this month. Now, of course, this is only a recommendation by the ESAs to the European Commission, who could choose to follow or ignore that recommendation. Therefore, at the moment, we cannot be categorical as to the specific disclosures which will need to be included in the periodic reports covering this 2021 reporting period. Pending any clarification on this point, we are suggesting that you establish a framework to ensure that the periodic reports published in 2022 contain all relevant sustainability-related information under the SFDR. Moving on then to the website disclosure requirements. At the outset, it's worth noting that there are no template disclosures to be followed in respect of the required website disclosures. Management companies with ESG funds under management have already had to update their websites to provide certain sustainability-related information since the 10th of March. More enhanced disclosure obligations will apply from the 1st of January onwards, with the purpose being to provide more detailed and current information than that provided to investors in the prospectus. So by way of example, the graph on asset allocation of the relevant ESG fund will need to distinguish between direct exposures in investee entities and all other types of exposures to those entities. In addition, more granular information on methodologies and data sources used by the management company will be required to be disclosed on the website. Furthermore, information posted on the website must be kept up to date, and in the event that that information changes, the website must contain a clear explanation of the relevant amendment. Moving on to the next slide. We're going to touch briefly on the changes coming down the line for managers who have chosen or are required, due to their size, to report on the principal adverse impacts of investment decisions on sustainability factors. And the purpose of PEI reporting is to provide information to investors on what harm the underlying issuers in which a fund invests have on environmental or social factors. High-level and principle-based disclosures on PEI due diligence policies were required to be posted on the website of the manager from the 10th of March last. This information will need to be expanded to address the more granular disclosure obligations applying under the Level 2 measures from the 1st of January onwards. For example, how principal adverse impacts on sustainability factors are identified and prioritised, and how principal adverse impacts on sustainability factors are addressed in the engagement policies implemented by the management company. From the 1st of January 2022, it will be necessary to identify and measure PEI using the mandatory indicators set down in the Level 2 measures. And in response to calls from industry, the ESAs have included different mandatory indicators to be used for investee companies, sovereigns and supranationals, and real estate asset classes. As well as assessing the PEI on sustainability factors against these mandatory indicators, management companies are required to select one additional environmental indicator and one additional social indicator from the voluntary list of indicators set down in the Level 2 measures. Finally, in addition to the mandatory and the voluntary indicators, management companies are free to report against other indicators which are not set down in the Level 2 measures. Continuing now to the next slide. The PEI report must follow a template statement as set down in the Level 2 measures. And the reference period for the PEI report runs from the 1st of January to the 31st of December in each year, with the report being published every year by the 30th of June. In-scope management companies will be required to publish their first PEI report by the 30th of June 2023, covering a reference period of the 1st of January 2022 to the 31st of December 2022. Now, because the information contained in the PEI report must be calculated in respect of a reference period using at least the average of 4 quarterly calculations, it would be important for management companies to start assessing what type of framework will need to be put in place to ensure that this information can be gathered on a quarterly basis from the 31st of March next year. Moving to the next slide, and before we turn to the taxonomy regulations, we thought it important to mention the proposed changes to the MiFID Suitability Assessment rules, which are expected to take effect from October 2022. These new rules could impact the classification of funds as ESG funds and may influence the portfolio construction of ESG funds depending on the intended distribution strategy. So currently, EU investment firms which provide either portfolio management services or investment advice, be it independent or non-independent, must conduct a suitability assessment on the investor prior to the provision of services. Under the proposed new rules, such assessment will now require these in-scope firms to ask investors about their sustainability preferences. And the definition of sustainability preferences set down in the new rules will in effect create a subcategory of funds which can be offered to investors. Meaning that, for example, certain funds, even though classified as ESG funds under SFDR, may not be sold to an investor if the fund does not meet the level of sustainability alignment requested by that investor. The next slide expands on that subcategory of funds and can be broken into three groups. So firstly, ESG funds which invest a minimum proportion in sustainable investments, and that minimum proportion is being determined by the investor. Secondly, ESG funds which invest a minimum proportion in environmentally sustainable investments, again, the minimum proportion determined by the investor. And thirdly, funds which consider PEI on sustainability factors. So this can include Article 8 or 9 funds as well as Article 6 funds, and where the qualitative or quantitative elements are determined by the investor. Because the definition of sustainability preferences focuses on the investor themselves being able to dictate the level of sustainability within their chosen investment, this could result in a scenario where, say for example, you have an Article 9 fund that has indicated a minimum proportion of 20% in sustainable investments, but that fund could not be offered to an investor who has requested a threshold of a minimum proportion of 40% in sustainable investments, notwithstanding that the fund in question is classified as an Article 9 fund under SFDR. Therefore, to the extent that a fund which falls within one of these subcategories is being distributed by an EU investment firm which provides either portfolio management services or investment advice, this is likely to be a key consideration in portfolio construction from October 2022 onwards, and something which you should start to give due consideration to. I'm now going to hand back to Cillian, who's going to turn his attention to the taxonomy regulations.
Thank you very much for that, Aisling. I'm now going to provide you with a brief overview of the taxonomy regulation, which will cover the following points. Firstly, legislative framework and scope. Secondly, disclosure obligations arising under the regulation. Thirdly, some of the key concepts which are necessary to understand in order to navigate the regulation. And finally then, the KPIs which must be used to disclose to investors the level of taxonomy alignment within the fund's portfolio. So on the next slide then, the key point with respect to the taxonomy regulations is that ESG funds which contribute to an environmental objective will be required to include some taxonomy specific disclosures in their fund prospectuses, either on the 1st of January 2022 or the 1st of January 2023, and that'll depend on the environmental objective being contributed to. But before we get into the types of disclosures that may be required, it makes sense to look at the legislative framework underpinning this new regulation. Now, as you'll see from this slide, it's not exactly straightforward, but what is worth noting at the outset is that the Level 1 prospectus and periodic report disclosure obligations are set in Articles 5 and 6 of the Taxonomy Regulation. However, the Level 2 measures relating to those disclosures, which effectively put the meat on the bones, if you like, of the Level 1 disclosures, are actually issued under the SFDR rather than the Taxonomy Regulation. And what this actually means in practice is that there is expected in time to be one single rule book containing the Level 2 disclosure measures under both the SFDR and the Taxonomy Regulation. However, for the time being, we will need to cross-refer to both regulations when assessing how ESG funds and their management companies are affected. Now, I should point out that the Level 2 measures which set down taxonomy-related disclosures for certain categories of ESG funds, and which are displayed on the right-hand side of this slide, are still in draft form, and a consultation on these measures only concluded on the 12th of April this year. And naturally, it goes without saying that this isn't an ideal scenario when the deadline for compliance is effectively less than 6 months away. But in any event, and separate to this, as you can see on the left-hand side of the slide, there will also be a number of Level 2 measures by way of a Commission-delegated regulation under the Taxonomy Regulation. These measures will set down technical screening criteria for each of the environmental objectives set down in the regulation. And these criteria must be used to determine whether or not an economic activity is taxonomy aligned. We will take a look at this in closer detail a little bit later on in the presentation. But before we go any further, let's take a look to see exactly what is meant by taxonomy on the next slide. So in short, it's intended to create an EU-wide classification system for determining whether or not an environmental and economic activity is sustainable or green. So from an investor perspective, the creation of this level playing field is considered by the European Commission as a critical tool to combat greenwashing. So in that vein, the disclosures which must be made to investors under the Taxonomy Regulation are intended to allow them to understand the degree of environmental sustainability of the investment. So in other words, to allow investors to assess at a glance how truly green the investment being offered to them actually is. So the Taxonomy Regulation will therefore apply to Article 8 and Article 9 funds which make investments which contribute to an environmental objective. It's very important, though, to note at the outset that the obligations imposed on these funds under the regulation are disclosure obligations. There's no minimum percentage of assets that must be invested in environmentally sustainable investments, which is also referred to as taxonomy-aligned investments. However, the fund must disclose its minimum proportion or target of investments in environmentally sustainable investments within its prospectus, and also its actual proportion of investments in environmentally sustainable investments in the periodic reports. So in the next slide, we will look at what type of Article 9 funds might fall within the scope of the Taxonomy Regulation. In the first instance, we know for certain that any Article 9 fund which contributes to an environmental objective will fall within scope and be required to make relevant disclosures. As I've mentioned, the Level 2 measures applicable to the taxonomy-related disclosures are still very much in draft form. However, under these measures, it's suggested that an Article 9 fund which does not actually contribute to environmental objectives may still be required to incorporate some, but not all, of the taxonomy-related disclosures. Now, this is because the draft Level 2 measures indicate that such funds will be required to disclose the minimum share of sustainable investments that are not environmentally sustainable investments or taxonomy-aligned investments. So what this would mean, for example, is that an Article 9 fund, which is a social fund, i.e. it contributes to social objectives as opposed to environmental objectives, could still be required to include some of these disclosures. Now, this would appear to go beyond the intended remit of these regulations, so we'll be watching with keen interest to see whether this extended scope is actually included in the finalised Level 2 measures. In the next slide, we look at Article 8 funds and how to determine whether these funds fall within the scope of the taxonomy regulations. So in this regard, the first question to ask is whether the fund promotes environmental characteristics. If it does, then does that fund invest in sustainable investments within the meaning of the SFDR? Now, this assessment is really important as the draft Level 2 measures indicate that an Article 8 fund which does not invest in sustainable investments within the meaning of the SFDR will not be required to make any taxonomy-related disclosures. So therefore, an Article 8 fund which promotes environmental characteristics and invests in sustainable investments will fall within the scope of the Taxonomy Regulation disclosures. It's similar to what I just mentioned in the context of Article 8 funds. The draft Level 2 measures suggest that any Article 8 fund which invests in sustainable investments which contribute to a social objective could be required to include some additional disclosure on the minimum share of sustainable investments that are not environmentally sustainable investments. Again, we look forward to some clarity on that in due course. So on the next slide then, what exactly does an Article 9 fund which falls within the full scope of the taxonomy regulation, i.e. an environmental fund, have to disclose under the legislation? Under Level 1 measures, the fund's prospectus and periodic reports must disclose, firstly, the environmental objective being contributed to by the fund. Secondly, how and to what extent underlying investments are considered to be environmentally sustainable using the criteria set down in the regulation. And thirdly then, the proportion of investments in environmentally sustainable economic activities as a percentage of all investments selected for the fund. Under Level 2 measures, template disclosures will be required to be used, and again, this is intended to ensure comparability of information. As shown in this next slide, Article 8 funds, which fall within the full scope of the Taxonomy Regulation, must provide the same information to investors as an Article 9 fund. However, they will also be required to include an additional disclaimer. That disclaimer will set out that only some of the portfolio comprises of investments considered under EU law to be environmentally sustainable investments, and that the remainder effectively of the portfolio is not considered to be environmentally sustainable. As I mentioned earlier, Article 8 or 9 funds, which fall within the scope of the Taxonomy Regulation, must firstly disclose in their prospectus and periodic reports the environmental objectives being contributed to by the underlying investments of the fund. But what are these environmental objectives? Well, they're set down in Article 9 of the Taxonomy Regulation, and as you'll see from this slide, comprise of 6 environmental objectives in total. And these are climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, protection and restoration of biodiversity and ecosystems. As we'll discuss later on in more detail, funds whose underlying investments contribute to the first 2 environmental objectives must include relevant disclosures in their prospectuses by the 1st of January 2022. However, those funds whose underlying investments contribute to the remaining 4 objectives must include relevant disclosures in the prospectus by 1 January 2023. So moving on then to the next slide, the next thing that needs to be disclosed in the prospectus and periodic reports is how and to what extent the investments of the fund are in economic activities that qualify as environmentally sustainable. But what actually constitutes an environmentally sustainable activity? Well, there's a 4-pronged test that must be satisfied under the Taxonomy Regulation in that regard. And these are as follows. Firstly, economic activity must substantially contribute to at least one of the 6 environmental objectives I just outlined. Secondly, the activity cannot do any significant harm to any of these environmental objectives. Thirdly, the economic activity must comply with the minimum safeguards set down in Article 18 of the Taxonomy Regulations. And finally, it must comply with technical screening criteria or performance thresholds effectively set down under EU law. So with that, I'll hand you over to Aisling, who will bring you through the remainder of the Taxonomy Regulation requirements.
Thank you, Cillian. I'm going to pick up on that 4-pronged test which Cillian just mentioned and look at each of the criteria in a little more detail. Once you have identified that the underlying issuers contribute to an economic activity that is covered by the Taxonomy Regulation, you will need to assess whether that activity contributes substantially to one or more of the 6 environmental objectives, and this is the first test to be carried out. This is determined by checking whether the issuer complies with technical screening criteria applicable to the environmental objectives being pursued by the fund. And these technical screening criteria will be set down in the Level 2 taxonomy measures. There are different technical screening criteria set down for each environmental objective and for each economic activity. In essence, the technical screening criteria are a form of environmental performance threshold, which must be met in order for an economic activity to be capable of being classified as environmentally sustainable. The technical screening criteria for the first 2 environmental objectives of climate change mitigation and climate change adaptation have been published and will apply from the 1st of January 2022. Continuing now to the next slide. Provided the economic activity meets the significant contribution technical screening criteria, you will then need to carry out 2 more tests on the relevant investment. You'll need to confirm that the economic activity does not do any significant harm to any of the environmental objectives. And this is determined by checking that a separate set of technical screening criteria have been met. And lastly, you will need to confirm that the issuer complies with minimum safeguards by confirming that they are aligned with certain labour law conventions, being the OECD guidelines for multinational enterprises and UN guiding principles on business and human rights. compliance with minimum safeguards needs to be assessed by carrying out due diligence on the relevant issuer. Moving now to the next slide. Once the analysis has been carried out to assess whether individual investments within a portfolio can be considered to be environmentally sustainable investments using the tests outlined above, it will then be necessary to calculate how this translates at portfolio level so as to be able to disclose to what extent the fund invests in environmentally sustainable activities. Under the draft Level 2 measures, the extent to which a fund invests in environmentally sustainable activities should be disclosed using a pie chart and must be calculated using a specific methodology as set down in the Level 2 measures. This involves computing the market value of all taxonomy-aligned investments held by the fund and dividing this by the market value of all of the investments within the portfolio. On the next slide, we've included the pie chart, which must be included in the prospectus and the periodic reports of any ESG funds which fall within the scope of the Taxonomy Regulation. I'm going to conclude with the next slide, which recaps on the timing of the application of the Taxonomy Regulations. For funds which contribute to the first two environmental objectives of climate change mitigation and climate change adaptation, the disclosure obligations will apply from the 1st of January 2022, while the disclosure obligations relating to funds which contribute to the remaining four environmental objectives must be complied with by the 1st of January 2023. Under current proposals, the Level 2 measures will follow the same timeframes, meaning that a fund which contributes to the first two environmental objectives would need to comply with the detailed template disclosures set down in the Level 2 measures from the 1st of January onwards. Significantly, it is not expected that these Level 2 measures will be published until October or November this year, which of course means a very tight timeframe for compliance. Back now to Cillian for some final thoughts.
Thanks, Aisling. Very tight indeed. So to conclude, we have summarised the proposed next steps for managers in this last slide. And these are as follows. So firstly, determine whether your ESG funds fall within the scope of the Taxonomy Regulation. Secondly, monitor the progress of Level 2 measures, which include templates, as we've heard, relating to SFDR disclosure requirements and taxonomy-related disclosure requirements. Thirdly, allocate resources, internal and external, to implement project plans for compliance with SFDR Level 2 measures and, where relevant, the Taxonomy Regulation. Fourthly, identify data sources or potential data challenges based on current portfolios. This has certainly been highlighted to us as one of the most significant hurdles for many asset managers. Also, be sure to consider the implications of the MiFID suitability assessment rules on portfolios construction, which, as Aisling mentioned, will apply from October 2022. And finally then, for those listening who are impacted, our last point to make for today is to start preparing now, as clearly there is lots to do. So thanks again for your attention and for your attendance today. And I'll now hand you back over to Alana for the Q&A section of the webinar.
Thanks, Cillian, and thank you both for a really informative session today. We have a few minutes to spare, so we'll take a look at some of the questions that have come in during the webinar. The first question that we'll take is one that seems to be on everyone's mind at the moment. Has the central bank confirmed whether it will permit a fast-track process for the filing of updated prospectuses by 1st of January next year? Cillian, do you have any thoughts on that one?
Thanks, Alana. Yeah, that's the million-dollar question, and we hope that they will. But at the moment, the central bank has not yet confirmed either way whether it will provide a fast-track process for the next set of filings, which, as we know, will need to be made by the 1st of January next year. We are aware that Irish Funds has made a submission to the central bank outlining the key challenges that the industry is facing in complying with the 1 January deadline, particularly given the delay, as we mentioned earlier on, in the publication of finalised Level 2 measures, and basically calling for the central bank to implement a fast-track process for the 1 January filings. Now, we'll see what happens, and we'll, of course, keep everyone updated as soon as we get more clarity on that.
Thanks, Cillian. That's really helpful. Another great question that's come through is, noting the key challenge faced by asset managers is the lack of availability of data, which may be required to meet the disclosure requirements. Do you think the recent proposal to revise the NFRD is likely to help? Aisling, do you have any thoughts on that one?
Certainly, Alana. Yes, I think lack of data is going to be a challenge for asset managers. And yes, I do think that these proposals are likely to alleviate some of the concerns around data challenges, but not all. I am conscious of timing, but I just very quickly, if I may, could give some context to that question for those who mightn't be familiar with the proposals. So there are proposed changes coming down the line in the form of a corporate sustainability reporting directive. And essentially the scope of this directive expands the list of EU companies which will be required to provide sustainability related information in their annual non-financial report to include all EU listed companies and all EU large companies, which is great and of course very welcome. But it doesn't extend to non-EU companies. Now, I imagine that the bigger non-EU issuers are likely to come under pressure from the likes of large institutional investors to disclose this information on a voluntary basis. But the smaller non-EU issuers will not be required to and may not voluntarily disclose it, so that's going to be an issue. Also, on the timing front, the CSRD is only expected to apply from 2023 onwards. So practically speaking, relevant data will only be included in periodic reports covering the financial year 2023. And of course, these would only be published in 2024. So whilst not an immediate solution for asset managers in complying with their disclosure obligations, in the longer term, yes, it will certainly assist.
Thanks, Aisling. That's really informative. I think it's fair to say it'll still be a challenge. I think we've time for one more question. So one of our listeners would like to know what happens to the level 1 disclosures which have already been included in ESG Fund supplements since 10th of March. Should they be removed once the template disclosures required under level 2 are included? Cillian, what do you think?
Thanks, Alana. I think that's a really, really relevant question. I think naturally it would need to be looked at on a case-by-case basis, but it's probably worthwhile mentioning that the ESAs explained at a recent open hearing on the Taxonomy Regulation that the template level 2 disclosures, which we talked about earlier on, are actually intended to satisfy the more general disclosure obligations which would have been included in prospectuses under level 1 and, as we know, which have applied since the 10th of March this year. But I suppose given that the template disclosures will, in practice be annexed to the fund supplement rather than being incorporated into, for example, the investment policy section of the fund supplement, depending on what the asset manager did for the 10th of March deadline, they may, in terms of where they disclosed information in the prospectuses, asset managers may choose to leave that existing disclosure as it is. But I suppose if you were to take that approach, you would need to make sure that there's nothing in that disclosure which contradicts the information included in the annex, which is required to be included under level 2.
We don't have time to answer all of the questions coming up today, so we'll have to stop there. But I would just like to say a huge thank you to Cillian and Aisling for their insights and to all of you for attending today, despite the glorious weather outside. The video of today's webinar will be uploaded to the Dillon Eustace website, so please keep an eye on our LinkedIn page for updates. Thank you and have a great afternoon.
Thanks, everybody.
Thank you all.